Okay, welcome to Alpha Silver episode 5. I appreciate you joining. Excited to do this quick update and just kind of re-emphasize a few points that we've made earlier and just continue to educate and to teach people to have patience, to wait for these markets to play out. Just providing more data and details on markets take time for things to consolidate and play out in the way that they do and that they are predictable. And so one of the things I wanted to mention and give some feedback on is we're now starting to enter the commercial part of the real estate downtrend. So typically, again, these processes take about 5 years, like the 2006 to 2011 one. It starts with medical properties. As we've shown before, MPW, which is a ticker symbol, which is tracks the medical property prices, has been hammered over the last 18 months. And now we're moving into the commercial, which we said would start, or I guess I said, along with other people that track it, that would start in October with debt starting to turn on those kinds of properties. And here we see that WeWork just announced bankruptcy. And so wanted to share this slide that just talks about default and loans and the trends that we're going to start seeing in the commercial space. And then once commercial space plays through, then we start to enter the residential. So we should start seeing changes in residential in earnest in 2024. So I just wanted to share this slide as economics. These kinds of things are going to play into sound money and why I do this podcast, which again is for educational purposes only. And I'll take the time here to personally request that you like and subscribe and share this with people that you love as well, so that we can get the word out. But the purpose of this podcast is to just get people educated enough to where you have a percentage, anywhere from 2% to 10% of your net worth in precious metals. So I just want to start with, again, some of the defaults that we're going to see. And right now we are still in a bear market, but with a bullish trend. We see, the GDP rate that was shared last month. Stock performance continues to go up for the Magnificent Seven, which is holding the market up. But again, these are all, as I've shared with Hedgeye and other things that I track, it's still a bearish trend. We're not going to get new highs. We're going to get new highs underneath the top high, which again is just a chopping trend downward. So that's what we'll continue to see. One of the things that's playing out, I want to get people educated on and just try to convey that these markets are managed, is paper and physical divergence continues, which means that the transparent depositories that are out there, there's a pull down or a drawdown in the overall holdings of gold and silver, which means that people are taking custody themselves and kind of taking it out of the market, which is a risk-averse behavior, which is making the metals and the bullion even more scarce. So you can see that in the blue line, that the annual transparent gold holdings in this case are going down, while again the price is consolidating at a high level. And then lastly, for today's podcast, just sharing again how the numbers are managed. This is a tricky graph, but basically what it shows, going back to 1970 here, you can see this is in the evening when the U.S. markets are closed. You can see that it's just basically tracking and proving that the price of the metals goes up when the big banks in the U.S. are not trading, doing the paper trade back and forth to basically set price. You can see that it starts to float and that it goes up. And basically that's a tracking of what the price would be if it wasn't managed the following day. So you're looking north of $250 per ounce. And then this is the inverse correlation to that. If it was managed like it is during our open market time, all the time, 24 hours, that the price would actually be lower than the starting point of when this started being tracked in 1970 at $1.09 an ounce. So And the red is what the current price is, about a $23 spot price right now. But again, this just shows the power of the paper trade, that the big banks, there's about 8 of them, they trade paper back and forth on the metals as a derivative, and it manages and sets price, as this chart proves. So anyway, this is shared again, that when these things change, when they can no longer be held up and sound money becomes the basis again, when people see the trouble with fiat and we all start experiencing it in earnest, that there's going to be a rush to precious metals. And so I'm just trying to educate people to get ahead of that and just get a portion. I'm not saying do anything crazy, not put it all there. There's no need to be fearful at all. It's just, again, just a logical, sound basis, conservative play. And again, you can go and confirm this with your portfolio manager. They should be based on your risk profile, suggesting anywhere from 2 to 10% of your holdings in metal. And right now, on average in the U.S., it's below 1%. For people, there's very, very few that have stacked some metal. So again, please do so, and like, share, and subscribe this video. Thank you.